Hello friends, last week in my video, I said the bulls were appearing a tad worried. And in my live mint column, I wrote markets were on a slippery slope. But the markets rallied on 3 out of 4 trading sessions last week. So what really happened? Are the bulls back? Is it going to be a bull market all over again? Or is this just a flash in the pan rally? In this week's video, I'm going to analyze just that. So diving right in is the market roundup window on your screen, which tells you that it was a bank Nifty which led the rally by gaining 3%, while the Nifty 50 brought up the rear by gaining 2.45%. The US dollar index, the Dixie, fell 52 basis points last week, helped the bulls because a weak US dollar is typically bullish for emerging markets, including India. What we saw is the USD INR, which is the dollar against the rupee specifically, also gave back 11 basis points. So the rupee gained against the dollar, and that helps control imported inflation. Gold and silver both rallied. It was really silver's week because it charged right ahead. And like I have been telling you in my various social media posts, especially on our Telegram channel, a free Telegram channel, I urge you to join that because I post a lot of my thoughts there. Bullion is likely to gain because inflation is stickier than what is being advocated. 10-year Indian benchmark bond yields surrendered 9 basis points, which means the bond prices rose. That created a mark-to-market profit for banks, and therefore banking also gained due to this. NSE gained 1.41% in market capitalization, which tells you that the rally was fairly broad-based, and MWPL fell, which is routinely expected after expiry of any derivative series. The US markets provided tailwinds by rising, and you can see that Dow, Nasdaq and S&P all gained together. Coming to our in-house indicators, I start with the MWPL or market-wide position limits. Now, this is the extent of positions utilized by traders as compared to the total allowed by SEBI. Post-expiry, there is a usual decline. As you are seeing on the chart, every 4 weeks there is a dip, that is the expiry week. And in the week gone by, we have dipped to 20.85%, which is the lowest in 20 weeks on record. Also note that in the run-up to the expiry of March series, the peak was at 29.81, which was also the lowest in 20 weeks. So risk appetite definitely remains subdued or smaller. For a bull market to start, you want MWPL to rise with prices. So this tells me that last week's rally, which I have been posting on my Telegram channel and other social media accounts, has been triggered very significantly. I'm not saying completely, very significantly by short covering. Now coming to the stock and index futures turnover, this is for all 3 cumulative expiries, which is April, May and June. The thunder was clearly stolen by stock futures because that turnover rose significantly higher, whereas index futures turnover, although did rise, but didn't keep the pace that the stock futures turnover gained. Now, this tells you that there was ample amount of participation, but also remember it was a weekly expiry and people roll over their trades from March to April, and therefore turnover is logged as double. So this is usual expiry related spike in turnover as well. Now for the NSE advanced decline ratio, which rose to 1.08, where 1:1 means equal number of gainers and losers. 1.08 tells you that for every 100 losers, there were 108 gainers. Now, this is the average of all 4 trading sessions last week. The NSE has gained Nifty has gained 2.45% and the advanced decline ratio has improved over the prior week but is just above 1. Now, in the coming week, which happens to be shorter by 2 trading sessions, so it's a very, very short week, it is less effort for the bulls to push the markets higher because Tuesday and Friday are holidays. So they need to push the markets high by on only 3 trading sessions. I want you to watch the NSE advanced decline ratio. Where do you get it? You get it on my social media accounts at the end of the day, especially on my Telegram channels, which is the most detailed platform where I put in the most amount of our views. Now for the prompt futures basis. What is basis? It's the future premium or discount prevalent to spot. Higher the basis, higher the risk appetite, all other things remaining constant. Lower the basis, lower the risk appetite. And if the basis is inverted, which means if the futures are trading at a discount to cash, that indicates short selling pressure. Now the basis has jumped. This was natural. As you can see on this chart, every 4 weeks the basis spikes. This is because a new derivative series starts. Traders have 1 full month to play around with and they are willing to pay a higher premium, just like you have in the options segment. So the basis has jumped. Whether it will sustain or not, it will be determined by A, the amount of buying that comes in, follow-up buying, and B, the closer you get towards expiry, the lower the basis will be. So net, this basis is unlikely to remain. It will come down over time by itself. Now for our in-house indicator, the impetus, which you won't get anywhere on the internet. You've trusted it since early 2021 and it stood the test of time. Now, one early warning that the markets were possibly likely to turn was last week. The markets fell in the prior week, that is, but the impetus had fallen, which means the falls that were experienced in the expiry week, in the last week of March before expiry, was on poor force. There was hardly enough selling momentum or pressure. And last week, what has happened is the markets have risen and so has the impetus. So relatively speaking, the rally has been on higher force as compared to the previous decline. It seems that there was more bullish momentum. This is a mild green flag. Now for the LWTD, another in-house indicator that you won't get anywhere on the internet. You've trusted it for almost a year now. And what you are seeing is the blue line, which indicates the Nifty 50. It's gained 2.45%. This is the highest gain, weekly gain in 20 weeks time frame that is covered by this chart. But the impetus has sunk deeper into the negative zone. It is at minus 0.29. That tells you that fresh buying support may be muted rather than the bulls lifting the markets. It could actually be bears covering their shorts, which could be the prime reason why the markets go up in the coming week. I would have ideally wanted the LWTD to rise with the rising prices, and then that momentum and that rally would have been a much more bankable rally, but it's not been. So that's a minor red flag. Friends, now that the in-house indicators are done and dusted, I come to the bond markets. Do remember that Indian 10-year benchmark bond yields fell by 9 basis points. Now that tells you that bond prices went higher. That's a sign of buying. All right. Do note that the coming week is when the RBI Monetary Policy Committee, the MPC, is likely to announce whether they are hiking rates or keeping the momentum stable. I promised you that there would be fresh opportunities in the fixed income market that will open up legally from 1st of April 2023, and I would share my thoughts with you. I have fulfilled that promise. The detailed editorial is there on our free Telegram channel. The hyperlink to my free Telegram channel is in the description and in the pinned comment below this video. Do make it a point to subscribe to that channel. I have also shared with you my views about what impact it will have on interest rate sensitive stocks. So that view stands. Now for the bond yield. Unless the Indian 10-year benchmark bond yield falls below 7.18%, I still believe that rates haven't peaked yet. On the flip side, if I was to see the Indian 10-year benchmark bond yield go up above 7.56%, I'd like to basically keep some check leaves spare, because I do expect that peak rates have not yet come, and I would get opportunities in the coming future. While the RBI headline yields coupon rate may not or may have peaked out, we don't know yet. At the street levels, I think NBFCs, banks, and other borrowers, bond issuers, will hike coupon rates. So do keep your check leaves spare. The more detailed analysis is on our Telegram channel. Do check it out. The bond yields done. I now come to the Bank Nifty, which led the charge on the upside, and it gained 3.08% on a week-on-week basis, rallying on all 4 out of 4 trading sessions, as you can see on the daily chart on your screen. What we have seen is that the price has closed above its month-long moving average, and that is a sign of optimism. For any kind of and sustained upthrust, the price has to remain above this moving average, and the moving average itself should turn upwards. On the chart, I have marked 4 arrows when the price had been above the moving average but could not sustain the momentum and fell lower. It has taken support at this blue dashed trend line. When I switch to the longer period weekly chart, you'll know why the trend line is there. So that support still holds. It's approximately 38,750 odd levels, that support. But for the bulls to come back, I would want the Bank Nifty to trade above the previous swing high level. And that previous swing high is at 41,671, and it was made on 6th of March 2023. This coincides with the 41,840 level, which was a swing low made in September 2022. So to be on the conservative side, I would say 41,840 is the litmus test for the bulls. Unless bulls take the Bank Nifty above this, I am not buying afresh. Till then, I would say rallies are pullback rallies. Now I switch to the weekly chart, and now you're seeing why the 38,757 level is 759, I beg your pardon, is important. All right, that was a swing high of March 2022. That is proving to be a support, and as long as that support holds, one can expect short covering to come there. The last weekly candle was a fairly prominent bullish candle, and the price has tested the 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull. That tells you that the medium-term outlook, though under pressure, has become a little more optimistic, but the average still remains pointed downwards. So for any sustainable upthrust to occur, the price should at least stay above this moving average, if not above the 41,840 levels that I have marked on the chart. So as far as I'm concerned, the weight of evidence tells me that so far it's a pullback rally at best. In the week before last, the Bank Nifty was at number 6 on the most volatile counters as per statistical beta that we maintain in-house. It rose 2 notches to number 4. That tells you that the challenge level has gone up because volatility has gone up, because statistical beta is nothing but pure intraday volatility. Now, last week, I advocated a range between 40,900 on the upside and 37,900 on the downside, which held perfectly well. In the coming week, I expect a range between 42,100 on the upside and 39,100 on the downside. Friends, the Bank Nifty done. I now come to the Nifty 50, which rose 2.45% on a week-on-week basis. As you can see on the daily chart on your screen, it rose on 3 out of 4 trading sessions to log the highest close after 10th of March 2023. Just like the Bank Nifty before it, on 4 occasions, the Nifty 50 has attempted to test or even overcome its month-long moving average, which happens to be sloping downwards. The price continues to make lower tops and lower bottoms formation. The price had fallen below the bold red trend line, which was connecting all the peaks made by the Nifty since October 2021. The Nifty has closed above its 20-day moving average, which is a month-long holding on cost. But will it succeed? Just like the Bank Nifty before it, it has fallen on 4 previous occasions. This time, for the sake of the bulls, I hope that the Bank Nifty and the Nifty stay above their moving averages, and then and only then would the bulls get the courage to push the Nifty higher. The litmus test, however, remains at the 18,115 level, 18,115. The weekly chart will tell you why. Now, moving on to the weekly chart, you can see that the 16,793 level, which I have marked with a trend line, has acted as a support both in September 2022 and in March 2023, barely 6 months away from each other. So this is now a line cast in stone. The bulls must not allow the Nifty 50 to fall below 16,793 or they might lose the initiative. The reason being that the price is below its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. The average itself is pointing downwards, and the Bank Nifty at least touched the average. The Nifty 50 is still below that average. So far, it indicates that the Nifty is also in a pullback, strong pullback rally mode, but it is not completely reversed yet. It will reverse the bearishness only above 18,115 level. In the week before last, this index was at number 19 on the most volatile counters list. It shot through the roof and gained 10 notches to end the week at number 9. Now that shows the amount of volatility that has gone up on the index, and therefore the fresh challenge that will be faced by the traders in the coming week. Do note that the coming week is shorter by 2 trading sessions. So there will be extreme amount of volatility in the market. So statistical beta will be high. Do curb your traded exposure to protect your capital. Last week, I advocated a range between 17,425 on the upside and 16,450 on the downside, which held perfectly well. In the coming week, I expect a range between 17,850 on the upside and 16,875 on the downside. Friends, the last bit of statistical analysis left here. I now come to the retail risk appetite as denoted by the amount of turnover captured by the 4 traded segment of the entire turnover traded. I showed you the index and stock futures turnover. Those were absolute numbers. Now we are going to see what contributed within that absolute number by what percentage, and now we are adding options to it. What happens when traders switch from futures to options? That denotes risk appetite changes, which is in a special video which I have recorded. The link to it is in the description and in the pinned comment below. So on your screen is a daily chart of the percentage contribution of turnover by various segments. The light blue line, sky blue line, is indicating stock options turnover, which has fallen on a week-on-week basis. Now, when traders are preferring stocks, they are taking higher risk because volatility in stocks is higher compared to the indices. Stock futures turnover again fell. That tells you risk appetite had fallen in both in stock options and in stock futures. What about index futures? That is denoted by the red line here. That is more or less remained constant. So, what was really happening? Retail players were saying, okay, let's play a low risk game. Let's avoid stock futures. Let's avoid stock options. And let's take a steady exposure on index futures. So, where was the turnover higher? It was higher in the index options, as you can see. The fall after the expiry of the prior weekly options was far deeper than the fall of the expiry this week. So that tells you that traders were taking a very, very low risk approach and concentrating more on index options turnover. Also, note there is a change in the STT on options and futures from now on. And in the initial few weeks, there might be a slight, very slight impact on the turnover, impact cost, and bid and offer spreads. There is a complete detailed post helping you analyze what I mean by that on our free Telegram channel and nowhere else. So please do go through that post as well. Friends, now I come to the segment where I share my thoughts about what I would do. Part of it is already shared on my Telegram channel where the fixed income outlook has been shared with you. What I would do is raise allocations to fixed income as against equities. Color me chicken, color me scared, whatever. That's up to you. I'm not saying sell. I'm not saying I'm bearish. All I'm saying is I'm rebalancing. Just like the mutual funds did ahead of 31st March. There was a lot of rebalancing because of which you saw the markets rise. I would rebalance. I would raise my exposure to fixed income. And the reason is in that free Telegram channel, you have mouth-watering deals which you haven't got for over a decade. I'm going to capitalize on that in fixed income. And I'm basically going to remain, my view remains unchanged on interest rate sensitives. Companies who are selling, depending on majority of their sales coming on EMIs. I'm also talking about a few cyclicals here. I will continue to bet on theta decay via the options route on those stocks. I would definitely allow for some headroom for up moves because the narrative last week that changed was, hey, the banking crisis in the US may not be as serious as it was expected to be earlier. And because the share of the US dollar in the global reserve currency and trade has fallen from 72% about a decade ago to 59%, and countries are doing more and more trade in non-US dollar denominated currencies, means that even if there is upheaval in the dollar, the world will move on and there is a certain amount of bravado in the markets. So I would allow my play on theta decay, some headroom on the upside, and then start betting again on theta decay on interest rate sensitives. The yardstick remains the same. I want above 21% yield per annum with low amount of risk on Jensen's and Jensen's measure and Traynord ratio. I would also continue to maintain my outperformed view on bullion. And I have been through the years bullish on bullion because I've never bought the theory that inflation is temporary or transitory, just like I don't buy the theory about interest rates having peaked out yet. So energy, like I told you, there will be a disconnect between crude and gas. Gas is appearing weaker, crude is appearing a lot more stronger. And this disparity might just widen a little bit. But like I told you last week, maintain a bearish bias if you want to, but don't short at any blind level. You'll have to pick out your spots with care because right now, what you're seeing is a short covering based rally coming in energy, especially crude. So be choosy about the levels that you're initiating your trades here. Friends, now I come to the most popular segment of this video for statistically minded traders, wherein I give you 5 names that have gained the most amount of beta on Friday, where you take small exposure, wait for large price moves, and 5 names which have lost the most amount of beta or statistical impetus on Friday, where you take big exposure, wait for small price moves. This is for scalpers. Do note, this list is valid only for Monday. If you wish to be updated on this list Tuesday through Friday, please subscribe to our free Telegram channel. That's where I post majority of our work. So the statistical impetus gainers list is led by IRCTC, followed by BEL, IEX, TVS Motor, and GNFC. Wow, it's all PSUs mostly. The impetus losers for Friday, on which you will take big exposure on Monday, wait for small price moves, is led by Astral, followed by Motherson, Biocon, Z, and Titan. Friends, I hope I've clarified my view about whether the bulls are back or it is just a pullback rally. I feel for now it's a pullback rally. It's too early to call a bullish reversal here in the markets. I hope this video added value to your understanding of the market. Do let me know in the comment section what you think about our work and how we are able to help you trade better. Also help us to reach out to fellow like-minded super sharp traders like yourselves by sharing our work on social media. If you haven't subscribed to my YouTube channel, I would request you to please do so and click on the bell icon to receive alerts about fresh videos being put up out here. Thank you for your patience in staying with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Bye-bye.